minus 9.15%. That is the massive single-day plunge we just saw in Walmart shares, an abrupt drop that sent immediate shockwaves through the broader retail sector and the entire equities market. Hello everyone, welcome back to AI Market News. Today we're unpacking a really sudden reversal in US equities, a sharp snapback in Treasury yields, and some stubbornly resilient economic data that's totally confounding expectations, all just days before a critical gathering of central bankers. Let's get right into it. Section 1. Walmart warns, and stocks tumble. Based on available data, this market reversal was incredibly swift. Looking at the day's price action on the charts here, the Dow Jones Industrial Average dropped a hefty 704 points. That's about 1.32%, settling at 52,759. Meanwhile, the Nasdaq declined 1.0% to 26,067, and the S&P 500 fell 0.87%. So what triggered this sudden sea of red? It was Walmart. They reported U.S. comparable sales growth of just 2.6%, which came in well below the 3.5% consensus. Now, you might be wondering, why did a single earnings report cause such a massive ripple effect? Well, we have to look at consumer trade-offs. Even though Walmart actually beat their overall earnings, that weak sales growth tells us high gasoline prices are really squeezing shoppers, forcing them to prioritize absolute essentials over everything else. This mechanism is a clear signal to all of us that the broader consumer base is struggling, and naturally, that realization dragged down other consumer-dependent stocks like Amazon, Royal Caribbean, and Carnival. Section 2. Treasury yields snap back. Just look at the aggressive climb, as you can see in the chart, with the U.S. 10-year Treasury yield pushing right back above that 4.7% mark. Just a day prior, a surprise Treasury Department buyback expansion had actually sent yields plunging. But as we can see, that intervention proved to be just a temporary fix rather than a lasting cure for the bond market. The 30-year yield also reclaimed the 5.25% level. Let's take a quick second to break down the yield equity mechanism. Basically, when bond yields rise rapidly, the guaranteed return on those super safe government assets increases. That makes riskier investments, like stocks, look way less appealing by comparison, so capital naturally flows out of equities and into bonds, pushing stock prices down. Section 3. Resilient data confounds markets. According to current market information, the underlying U.S. economy simply refuses to cool down. Weekly jobless claims actually fell to 206,000, which beat the forecast of 210,000 and extended this long run of historically low layoff activity. And on top of that, the Philadelphia Fed Manufacturing Index completely surged to 47.4. I mean, that absolutely blew past the consensus estimate of 24.1, really reinforcing the narrative that factory activity remains robust. Then, the week's final major data point arrived Friday morning Eastern Time with the S&P Global Flash PMIs. The services sector really led the charge here, hitting 56.8. That is the fastest expansion since December 2024. But here's the catch, and it's a big one for inflation watchers. Output charge inflation within the services sector hit a near 4-year high. So while manufacturing growth did slow down just a bit, this heated services data is a detail the Federal Reserve will absolutely not ignore. Section 4. The Nikkei and USDJPY reaction. As the graph shows, the Nikkei 225 experienced significant turbulence, ultimately pulling back 200 points, or about 0.3%, to close near 66,016. And that was after massive intraday swings of over 900 points. Basically, the weakness we saw in U.S. retail directly weighed on Japanese consumer names like Fast Retailing and Ryohin Keikaku. That downward pressure counteracted the support we were seeing in semiconductor stocks. Now, turning our attention to the foreign exchange market, you can see in the chart that the USD/JPY pair is firmly holding its ground, pricing right near that 158.9 level. Despite all the volatility we just saw in equities, the dollar has maintained its strength against the yen. And that's entirely supported by the renewed climb in U.S. Treasury yields that we discussed earlier. So what's the underlying mechanism driving this currency pair? It's all about the yield gap. Because the Bank of Japan maintains relatively low interest rates compared to the Federal Reserve, a rising U.S. Treasury yield creates a much wider gap in potential returns. Global capital naturally flows toward those higher U.S. rates, driving up demand for the dollar and, in turn, weakening the yen. Section 5. Jackson Hole looms ahead. All of this brings us to the highly anticipated Jackson Hole Economics Symposium next week. Federal Reserve Chair Warsh is scheduled to deliver a critical speech on Friday, August 28th. After the recent FOMC minutes revealed a much broader hawkish tilt than any of us expected, his upcoming remarks take on immense significance. The market is waiting to know, will he validate the hawks or will he signal patience? The stakes here are clearly defined by the numbers. Right now, the odds of a September rate hike sit at roughly 34%. Depending on the tone and specific wording of Chair Warsh's speech at Jackson Hole, that probability could shift decisively in either direction, potentially triggering the next major leg of volatility for both the dollar and global equities. As we close out a week truly defined by competing forces, the underlying debate about rates, inflation, and growth remains totally unresolved. Looking ahead at the economic calendar for next week, we'll all be keeping a close eye on the ongoing inflation metrics and, of course, those definitive remarks from the Fed at the symposium. So, as the global economy walks a tightrope between consumer strain and resilient inflation, the ultimate question remains, are we heading for a soft landing, or is the ground about to drop out from right underneath the market? We'll be here to break down all those developments as they happen. Thanks for watching. Please subscribe and hit the like button. This explainer was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This explainer does not constitute investment advice. For full details, please check the description below.